Hearst and I can joke around because I've covered DCM for so long, for what, since DCM started, just about.
Yeah, for a long time, yeah.
For a long time.
For a long time.
For a long time.
Now it's 2012, so it's not quite 15, it's 12 years ago. But anyway, well maybe it's 15. But anyway, back then everything happens in Silicon Valley. There was nothing going in trying to do entrepreneurship in China is actually trying to do anything got to do with China and trying to convince VC to VCs crawling the streets of Beijing and Shanghai like me. And so it's really not a question of finding money in China. It's really a question of how do you break out? How do you do a better job than the other competing and can grow faster than the other guys.
Listen to a story about China. So how can you explain?
I think the context is different now. I think the context is that there has been a huge investment in China. Not only money from now, it's like people kind of there's always a flavor of the month, and people are always looking for the latest, the greatest, and it felt U.S. pendulum will swing back, but definitely there was a sort of like allergic reactions in 2011 and 2012. I think for those of you who are in my business know that the company that DCM did, VIP Shop, went public in March and got to a very icy reception, and we had a lower price multiple times in order to go IPO. But more recently, it's now voted by all recognition as now the best performing basically tech stock out of China in the last, the only tech stock out of China last more than a year, probably last 18, 20 months. And it's performing, it's more than double since its IPO. So I think I wouldn't say enthusiasm, but certainly the willingness to accept that there are good companies out of China. I think that willingness is coming back. I wouldn't say it's a giant's wave, but I think it's trickling in. So I'm optimistic. I'm optimistic. I think 2013 will definitely be better than 2012, but it will take time.
Well, VCs are always optimistic, right?
Yeah, if you're an optimist.
You can't be in that business unless you're an optimist. But if you look at the figures for 2012, first 9 months of this year, right?
Yeah.
Deals are down 44%, dollars are down 44%, IPOs are
Zero. Well,
zero,
except CIP, right?
right?
CIP,
Except for a Hearst
Right.
deal. So, I mean, is it realistic to be optimistic?
Of course. Of course. Because fundamentally, I think if you don't just look at the short-term money, which is the Wall Street money, if you don't look at that and you look at across China, mobile is a very big hot space, and people are using mobile all the time. And of course, there's people who's wondering, so like Weibo, right? In Xinjiang Weibo, you have not been able to monetize. So what's the deal there? But at the end of the day, it's my belief, because I went through that. It's my belief. Eyeball is money, and if there are a lot of people using Weibo, and there are a lot of people using other, like Weixin and other kind of mobile applications, eventually the money will come. Eventually, monetization will come. You can be skeptical about it, but people were skeptical about Sina, about the internet advertising space for a long time. It was always very difficult to convince people that you could make money on internet advertising. People at the time when I started believing, newspaper advertising, for instance, I was told by one of the investors, saying that South China Morning Post makes like 10 times more money than you do. How can you even, and that's just the local newspaper in Hong Kong, and here you are, you claim to be the biggest pool in China, and how can it be? But as time proves, that newspaper then subsequently went into a long, deep dive, because people have increasingly turned to internet in the past decade to get their news. And I think mobile will happen. And the victims of this change might actually the very same internet companies that was taking money away from the traditional newspaper and traditional conventional media like televisions and radios. I think mobile will take that away from both television, radio, and newspaper as well as the internet.
What do you see today that's as hot as the mobile internet? Is there anything else that's really as hot in the spaces that you monitor? Because I hear mobile internet, right? Maybe some cloud too, but is there anything else out there?
Everything else, I think mobile is once in a decade life-changing wave because we all carry iPhone, iPad, just making comments. I don't carry PC anymore, so I think that is the big thing. Underneath that big huge wave, there's all the other different applications under that big huge wave. So I think mobile, just like internet, it's a huge wave. So we should all get on that. And of course, I'm a VC. I don't want to tell you what I specifically get on because I'm worried about competition. but we should all get on that. That's for sure. That's a no-brainer.
Oh, okay.
And then everything else that DCM looks at is a little bit more one-off thing. We look at opportunities in education. We look at opportunities in some consumer items, but they are all related to internet one way or the other. We also look at healthcare, but not in the strictly medical sense. We look at healthcare in terms of how internet and mobile would assist people make better selections about their healthcare choices, or better selection about doctors, or doctors make better communication with each other and with their patients. I think we look at those as well. But these are, I can't say they're particular big giant wave. I would say they're one-off opportunities that in and of itself could become a billion-dollar company, but the industry itself may not be a $100 billion industry or $30 billion industry. I think those things are a little bit too niche for that. And I also think that, I think everything else is a little bit related to mobile. Okay, so I'll get a little bit more specific. For example, even on video, I think video was a big thing about 3-4 years ago, where YouTube paved the way maybe 6-7 years ago, and there was a wave of video in China where you watch video on the internet. So now you start turning to watching video on your cell phone. But there's a problem, right? Because your cell phone screen is only this size, and your bandwidth is relatively limited. So there should be a dynamic bandwidth allocation depending on you're coming into Youku or you're coming into Tencent, right? I gotta put in a plug for Tencent. We gotta know where you're coming from. If you're coming from, a television screen, and then we gotta want to give you like high definition, right? But if you're coming from a little, handphone, cell phone, and you're probably down in the subway, and so you're very poor connection, there's no reason why we should give you HD, because first of all, it's impossible. Second, you don't need it because your screen is so small. So this kind of thing itself is actually a pretty big implications because we are all consuming video, and it's not just video of pre-made program, but video with communication with your parents, your family, or maybe some kind of a security camera of any type. So maybe some kind of monitoring of your dogs, who knows, right? So anyway, it's just that alone. So that's what I mean by mobile is a giant wave. But underneath it, there are different verticals that you can take a look at, and we take a look at these. So we think that is the new wave. But again, I said, besides that, healthcare, education is those two areas we look at.
Okay. So how did DCM manage to avoid this social commerce boom? I don't think you have any portfolio companies that are focus primarily on social commerce, where a lot of other venture capital firms in China did back social commerce startups. And there were something like 1,000 social commerce startups in mainland China. How did DCM manage to avoid that? Do you have some sort of special radar?
No, I think we probably, because we were investing in Renren, so we saw a lot of the Facebook kind of activities. I think in a sense, because we're in Renren, we know some of the stuff, we felt that it was too much, I guess too much bubble too fast. So by the time we kind of got our heads together, when we look around, many of these startups were either too niche, okay, so you can't see them becoming $1 billion company. If you can't see them become $1 billion company, I mean market cap, not necessarily sales. It's the risk you take is too high, and then the second thing is we felt the valuation was too high even for the leading companies, and so we kind of just sort of sat out maybe, but definitely. I think if you go on Taobao, you go on 360 Buy, you basically do a lot of searching, right? You search for what you want, and now as more and more items are getting sold over the internet, it becomes increasingly cumbersome for consumers to search. They should search, but I think there's another need for recommendation, for serendipity, for discovery. And that's what social commerce is about, and that's why it's causing such a bubble in social commerce. And I think that need is not going to go away. That need will get bigger and bigger. You know, for example, the one that we talked about, VIP Shop, it doesn't have searching there. It's all about discovery, and it's all about recommendations, and it's done quite well. I mean, the VIP Shop is about 80% women shoppers. I mean, all shopping sites are my women, as everybody knows, right? Most of it, or the most expensive one.
I don't know, what about golf?
Very niche,
Oh,
very niche. But you've been talking about. So in that particular case, we also discovered that we are not impacted by Taobao because we don't have search. It just, you know, it's a flash sales model. Some of the women in the audience probably knows what that is. It's a flash sale model. You know the brands, but you don't know what's in the brands. You got to go in there at the appointed time and limited pieces for you to choose from. So it's all about discovery and recommendation, and I think that is something that consumers are looking for. Besides search, I think search will start is continue going to be search and compare will continue to be the mainstream. But I think discovery, serendipity, and recommendation will also be the other yet to become mainstream phenomenon.
So you brought up Renren. Renren, China's often referred to as China's Facebook. And if you look at the stock price recently, you have to sort of wonder what's going on with the company, what's the long-term outlook for Renren. So I'd love to hear your response to that. I know it's not your deal, but...
Well, Tencent is here, that's the answer.
Oh, yeah.
Yeah, no, I mean, I think that's, you know, I think the Joe, a fellow Stanford grad, is a very smart guy, and he's done a lot of stuff. He's made a lot of investments, and I think he was quick and early in terms of picking out the social aspect of what's going on in China, and that's why he started Xiaomi, which then later on became, well, he didn't start, he bought it, and then later on turned into Renren. And so I think he's doing a great job on it, and we will continue to have confidence that he will continue to work that company and make it a giant success.
Is it going to move farther and farther apart from Facebook?
I don't know. I think they're looking at gaming. Obviously, gaming is a very big, same thing with Tencent. Gaming is continuing to be a good substitute, good entertainment substitute for televisions and all these other stuff. So I think they're looking at gaming. They're looking at, more recently, they together with DCM actually involved with not social commerce, but social financing. And this is very interesting. It's not in China, and it's actually in the US, it's in the States. And it started by yet another Stanford grad. When he was going through his business school education, he said, why do I have to pay the same bank rates, loan rates, as the guy who goes to the University of Phoenix, right? Because it's the government of the United States mandate the student loan rates. And that rate is based on all the default rates of somebody who went to a local community college and the one who went to Stanford Business School. So he said, correctly pointed out, the one in Stanford Business School is going to default a lot less, infinitely less than the one that goes to the community college or University of Phoenix. So he basically says, I don't want to become a bank, because if I become a bank, then I become subject to the same regulations that will require me to offer the same rate to everybody, regardless of your creed, religion, color, whatever, including where you live, right? So he wants to become a peer-to-peer lending, and so that's where the social lending comes in. But the area he focuses on is not what the so-called micro-lending that was like a big deal back half a decade ago, but rather focusing on student loan. And he got a good start with Stanford Business School, quickly spread to Harvard and all the top 20, 30 programs. So it's become, they're making billions of dollars of loans now every quarter.
Yeah.
I guess it depends on the semester starts, right? Or the quarter starts. And so they're making a lot of money. And so for a Stanford, for a alum, fellow alum, first of all, he gets a good rates with a relatively safer investment, and he gets a good rate, because right now, if you put your money in the bank, you're probably getting, the overnight discount window is 0.25%. I think you're getting 0% on your savings account, if I'm not wrong. And so, just about, right?
Yeah.
So, and even putting a CD, you probably get 1%, 1.5%. And here it is, the government Pell Grants, the government loan is about 6% or 6.5%. And you're lending to a fellow Stanford grad or fellow Harvard grad or wherever the school is. And first of all, you feel like you're doing something for your community. And then secondly is you actually get a good 4.5% or 5%. And the default rate is actually relatively low. And the student themselves, they feel like, well, I'm paying the same anyway, but borrowing from my alum, actually, to him it feels like there's more of a community in it. So, there it is.
Okay. So Hearst, as a VC, how do you pick the entrepreneurs that you back? Do you have some secret that you can share?
I think entrepreneur come in all sizes and shades, but generally speaking, I think entrepreneurs come in two types. One is they're super smart, they just kind of like a supernova, they radiate, you can tell, right? Now, those kind of folks, chances are everybody wants to back them, and you got to pay a very high price for it. And sometimes you should because not only do you have a good investment on your hand, you could also learn from that entrepreneur, because he's always filled with new ideas that you can learn from, because we can learn from entrepreneurs as well. With VCs practically know nothing, so because we're a jack of all trades and a master of none. And so you can learn from the entrepreneurs. But then there's the other kind, which is the one that, kind of like myself, kind of a little bit not so rough on the edges, probably, voted as the least likely to succeed in high school or college or what have you, and but has a sort of like a you don't want to lose, it's sort of like an underdog mentality. Like, I just want to prove them wrong. They all think I'm really dumb, and I want to show them that they're wrong. And so when I interview them, I try to find that kind of trait in them, because those kind of people will really, really go the extra miles. And they really do appreciate that you take time out with them And they will, when chips are down, they will sacrifice themselves for investors. And that is actually relatively tough to do in China nowadays.
That's very interesting, Hurst. I hope everybody was, every entrepreneur out there was taking notes on that point alone. So, I think today is a lot different than it was 5 years ago, and it's become kind of rough out there for VCs to find good deals and to pay reasonable prices for these deals. And I mean, is it really kind of like a survival of the fittest time for VC firms in China today?
I think VC make pretty good money no matter how either way you look at it, and I think it's not really. I think for a while there was a lot of money going to China because people want to get that extra returns like they couldn't get in the U.S. So there was a lot of money being plowed into not just VC. Actually, VC is not the big portion. PE actually gets a lot of money as well. PE actually gets more money, and there's just being a lot of money. And when you have a lot of money, what it produces is actually a lot of copycats, a lot of Me Too investments. If there was one Facebook, then there's 100 other Facebook. If there's one Pinterest, there's 100, 10,000 other Pinterest. So when you have too many lookalikes, then what happens is nobody makes money. Everything becomes commodity, and all the profit margin go out the window. And I think today in the VC world, really VCs have to become more disciplined, and VC themselves have to become more disciplined. So I always said to my own staff, because for a while they're all the right, because it's important to get on the league table. Every time the bankers, obviously I'm sure there are bankers here in the audience, because we're in Hong Kong, bankers come, they always put up their league tables, and Hurst Lin or Lin Zong, you're number one in this league table, number one in this table. And you get the smallest bank, and they will be number one in something, because you gotta be on the league table, right? You gotta be on the league table. So DCM's gotta be on a league table on something too, right? Everybody's gotta get on a league table, and you know what? I mean, that drives to a certain. I think it's not a good behavior, because I tell my own staff and myself, it's not important to be number one. It's not important to be the biggest. Okay. It's more important to be unique. Okay, don't try to be the biggest. Try to be the most unique, because at the end of the day, that's going to bring home the bacon. And I think that's my advice to myself, and that's my advice to my companies. I said, go big or go home. Great, that makes sense. But when everybody is going down the same path, then you know what? You'll probably bleed to death before you reach destination. Right, and so there's a little bit of that. I think there's got to be a little bit more discipline, and I'm trying to practice that discipline.
But does every company you back have to be potential of $1 billion valuation?
Yeah.
Yeah, really?
Yeah. I think so. I think. I think China is not quite at Silicon Valley stage where Rebecca and I originally come from. Well, she's still there, but I think in Silicon Valley and in U.S. in general, there's a lot of buyers stand ready to pay top dollars, even for a particular team, for a particular functionality, for a particular customer group. But I don't think that is quite there yet in China. Obviously, you have Tencent, who everybody's trying to sell to, right? But there's only one or two, Baidu, Tencent, and then maybe Alibaba Group, and that's about it. So there's not enough buyers. So in that sense, for VC, if you don't back that $1 billion company with an IPO as the ultimate exit, you could just die. You could just somewhere become stillborn. And that is not good for the shareholders. Yeah.
Interesting. What do you think about the going private trend today? I mean, for years we had the going public trend. Now we have the going private trend. So what do you think about that? Is that realistic?
going private comes and goes. Obviously, there was these so-called pipe deals that was, comes in vogue every 5 years, or maybe every 3 years. And I think this idea of going private, it just goes against the grain of what we do. So all of a sudden you have a VC comes out before, like 2 years ago, he talks about taking every single company has private, public, and now he's talking about some company private. I don't do it. I think it's hard. When I was at Cena, when the stock was trading at above there, I looked into going private. But it's very difficult to do. It's very, very difficult to do. And I think there's got to be a special circumstance that you would do it. And it probably is more for buyouts, where the company is big and it's an established industry. People know buyout can go in there and actually fire everybody and put in their own CEOs and squeeze the last dollar out and then make it very super efficient and then go public again. But for a tech company to go private, the landscape changes on you all the time. So there's a reason why your stock is trading so low. It's probably the paradigm has already shifted on you. And it's actually more important for you to change, to come up with a new, find out where the new paradigm is and try to get there before someone else gets there, which is similar to what Cena did, right? Because the internet portal paradigm has come and left like in 2003 and 4. And so you had to, thank God for, the mobile, right? Mobile SMS that kind of saved us. But then we had to quickly go to blog, right? Broker, and then we had to move on. Ultimately, like you said, yeah.
Okay, so certainly the VC business is very cyclical. What do you think is the long-term outlook for VC returns from Chinese companies?
I think it would still be, relatively speaking, I think in the world, right now, if you look around the world, there's really only 2 VC markets. One is United States and one is China. And you have more niche ones like Israel, right? Because there are a lot of smart people and coming out with brilliant ideas. And India, which is, trying to get up to the same level as China, but not quite there yet. And so those two, and it's got to do with the culture. I think, people say Chinese are racist because they think they're really good, right? But there is an inherent Chinese culture that want to start their own business. That's why Chinese are terrible service providers, because they all want to be boss. No one wants to wait tables, right? So you go to Chinese restaurant in the U.S. or normal restaurant in Shanghai. You can't get any good help. Right, so because everybody wants to be boss, nobody wants to work for anybody, right? So, but because that mentality causes a lot of just people trying to start businesses. So there's a cultural aspect to it. There is that risk-taking aspect to it. So I think China will be a big market, U.S. will be a big market, and because these are the really 2 credible big markets. So in the long term, at least, for the next 10 years, I think China will still deliver very good returns because of that. Eventually India will come up, Brazil will come up, and the other place will come up, and then there will be fight for the money to go there. But I think those places have not reached critical mass yet.
Okay. So what advice do you have for a young entrepreneur starting out today?
Be humble, try to, try to innovate all the time. Don't try to be a me too. It's easier said than done because you can pound your head against the wall and all you can see possible is trying to beat out the next guy doing the same thing. So because there's so many copycats that's gonna come and copy you, you gotta stay ahead. And the secondly is you have to be frugal, So stay with your mom, stay with your girlfriend, staying homing, when you travel or stay at your friends. Really just have to be frugal. I think a lot of the entrepreneurs in China when they have a lot of money thrown on them, they kind of lose themselves. They want to hire as many people as possible so they can be like the big boss with a big office, have their own big floors, multiple floors, and they all pay. They all ended up having to cut back. They all ended up having to kind of slim down, and that is very bad for morale. So it's probably better off you don't go down that path in the first place. Of course, you will always have your reasons. If I don't get a big office, I can't hire good people. I cannot get those good industry veterans to come work for us, if I don't have a fancier office. That's true. It's all very true. But at the end of the day, things change, cycles come and go. I think it still is stay frugal and stay hungry. That would be my advice.
Okay. Sounds a little bit like Steve Jobs' advice.
Second part.
Stay hungry, stay foolish. Does anyone have a question in the audience? Okay, I think we have, and then ask your question.
Hi, my name is Vicky. I run Zao Zao, which is a fashion tech startup with my partner Ling sitting next to me. We've been up and running for probably 6 months now, so we're starting to actually take meetings with VCs. And to your point earlier about, there are a lot of VCs in Beijing, Shanghai crawling around now. One thing that we've noticed is that there is no problem with quantity of money, but it's the quality. So given that you've been on both sides of the fence, both in 96 as an entrepreneur and now as a VC, do you have any tips on how to weed out the clowns from those who are actually worth our time?
Money is money, if someone throws money at you, you should take it. When I was down, I took any dollar that come my way, I tell you. Okay, so let's say you were fortunate enough to have multiple term sheets thrown at you, okay, then that's a very high-class problem to have. And if you have that high-class problem, then I think you should interview VC like the way you interview your prospective employees. You don't try to be nasty about it. People think you're really arrogant, right? But you should then interview VCs and try to understand, whether or not, first of all, whether or not they themselves have operating experience before. Because if they have gone through operating experience, they have started their own company, they have founded their own company, gone through the ups and downs, and also, went through the so-called trying to figure out a breakout strategy, it's counterintuitive. And so you should interview them to see whether or not they have those kind of backgrounds, because one of these days you'll come out with an idea and like people on the board is going to go, or your employer is going to go, what? And that's the time when the VCs who truly understand, that you need to break out will support you. Otherwise, they will fight you tooth and nail because it is their money that you're playing with. And so if you have the high-class problem, then you try to find those VCs who can be, like Rebecca said, be foolish with you together. So that's what you want to interview. That's what you want to interview for, rather than taking the highest valuation. I say that, but I know it's hard to do when you're an entrepreneur, because I was there. And your tendency is always gravitate toward a higher valuation because it's an ego boost. And I went through that. I'm glad I didn't take the higher valuations because that eventually turned out to be the right thing. So you should interview if you have that. And also, some of the financial investors are not very ethical. They just kind of put the term sheet out and get you, especially the one that willing to pay the highest price. They just want to lock you down, right? In Chinese or more crude, they just want you to take off your pants and they can look at it before, and then decide what they want to do, right? But by the time they look at you, hey, and they don't put money in, then everybody's saying, oh, what? He had a look, so must be something wrong. Right, so you want to be very careful about that. You got to make sure that the person that you want to work with is something that you are not gonna, get like allergic reaction later, right? So you want to be when as a fit, and then secondly is you want to see if the person is sincere. I think sincerity is very, very important, and typically you don't get sincerity from the highest bidder. There's a reason why they put in the highest bid, and you got to find out why.
This sounds a little bit like real estate. Does anyone else have another question? Yes, here. I'm going to give you.
Want to swap the mic? Want to swap the mic? Swap the mic.
Oh, that one has the one. Okay. Here you go.
Thank you very much. Thanks very much. First, my name is Joshua Miller. I work with a group named OK.com, speaking of real estate. We're a early stage, not a startup so much, group that has developed a software, enterprise software for the real estate space. We're looking to disrupt it, mobile, etc. Two questions really. One, touching on what you just answered, how would you go about doing due diligence on the VCs, besides your gut feel of how sincere they are looking at their valuations? Are there any other...
On a startup, that itself is kind of problematic, because a startup fundamentally has nothing you can DD on, because it has no revenue, it has very small, all you have got going is the founders and maybe the initial team and the idea. And so for early stage VCs, doing due diligence is very, very difficult, and it comes down to, it still is, for me, is to get to know the entrepreneur and to see whether or not, if I will develop an allergic reaction with him or her 2 years down the road when things aren't going well. So I think with the early stage, if you want to do a due diligence on VCs, I would actually say, besides the regular background check, what did he do? Did he really do what he said he did? You can Google that, that's relatively easy. And you can also try to find out you can know what other company has put money in, and then you can try to find out from the inside whether or not that VC had gotten along well with those companies.